Registered representatives offer securities through Independent Financial Group LLC, IFG, member FINRA SIPC. Investment advisor representatives offer advisory services through Independent Financial Group LLC, IFG, a registered investment advisor. Cornerstone Wealth Management, IFG, and Dunham & Associates Investment Counsel are unaffiliated entities. The information and opinions presented are for general information only and are not intended to provide specific advice or recommendations for any individual. You should contact your investment representative, attorney, accountant, or tax advisor with regard to your individual situation. The opinions of the presenter do not necessarily reflect those of Independent Financial Group LLC, its affiliates, officers, or directors.
If you're nearing retirement or worried if what you've saved is going to last, then this is the podcast for you. Now let's join Cornerstone co-founder Jamie Avila for the Cornerstone Retirement Blueprint Podcast.
Thank you for joining us today. My name is Jamie Avila, managing partner of Cornerstone Wealth Management. And this is the conclusion of our series here with Sal Capizzi with Dunham Trust. And we kind of say for the best for laughs. I know that this is a topic that you're very passionate about, right, Sal?
It absolutely is.
Yeah, and it is the kind of proprietary program that Sal and Dunham have put together. It's called the IRA Trust Trilogy. And this is a little bit different than some of the other things that we tackled in previous series, where it's really about the donor, the person that's actually putting the CRT or the donor advice fund in place. This is more about family. It's about taking care of them and really putting more of your hard-earned money from your qualified money, your IRAs, into your family's legacy, into their pockets, than the IRS. And so back in January of 2020, the legislation that was passed was through what we call the Secure Act. And basically the IRS in that act wrote themselves into all of your 401ks and IRAs. And most of you don't even really know, or maybe you've heard a little bit about it. But the main rub about what they did was they were able to lower the time horizon for when taxes are paid on qualified accounts. And so, Sal, tell us what I mean by that. Break it down for our listeners about what really happened.
So in the old days, we used to call it a stretch IRA. So you were able to stretch the taxation for your beneficiary's entire lifetime. What's changed now is by the 10th year from when you pass away, your children are going to need to pay the tax. Here's the issue. And when you say passionate, this is the reason why. Because when you take a look at IRAs, because the people who are retiring right now are one of the first groups that had 401ks literally for their entire career. And because of the type of market we've had since March of 2009, which basically, with the exception of 2018, has always been a positive year. You've been seeing your 401k growing. It is not uncommon to find your 401k or your IRA combined to now be over $1 million. So if you suddenly tell your kid that in the 10th year they have to pay the tax, you're likely putting them in the highest tax bracket possible. Now, I live in California. We've made jokes about me living in California instead of out here, right? But that tax is over 50% to my girls, right? When they receive my IRA, and that is a shame that half of my IRA is going to wind up going away in taxes.
Yeah, it sounds to me that it was kind of just a money, right? At the end of the day, instead of letting you lengthen that over somebody's life expectancy for possibly 20, 30 years, they want their money sooner, right?
So in fairness to Congress and IRS, what they did in the Secure Act as well was they took the required minimum distribution from 70 and a half to 72. Exactly. Yeah. So the question becomes then, how do you pay for that? Because now you have, the baby boomers are the largest demographic group. So if you're saying, all right, now we eliminated a tax base for 2 years, right? How do you make that up? And they said, well, I know how to do that, right? We won't tax the retiree, but why don't we hit their kids? And that's what they did.
It's easier to tax the people when they're dead, right? I mean, they can't really protest
they can't. They absolutely can't.
So, yeah, no, it's a shell game, like you said. I mean, they give you something and then they take it away over here. But that's very interesting. So tell us a little bit about how the IRA Trust Trilogy is able to combat kind of what happened in 2020 in the Secure Act and provide relief for somebody who just doesn't like the way it's set up like that.
Well, so what the Trust Trilogy is, it's simply 3 different trusts, right? And Jamie, I know you use it, and I know that you use it because you love the deeper level of planning that you're able to afford, right? So I'm not teaching you something, but for your listeners, right, what this basically means is that with the trilogy is we're able to handle 3 things that are critical for your family when it comes to your retirement assets. The first thing is, how do we create a better situation for them with the Secure Act so that they have more economic benefit from the IRA that you've worked your entire life to accumulate, right? And how do we make it so that IRS doesn't come in and swoop a good portion of that away within the 10 years that you pass away? Second thing is, there are issues sometimes in certain families for certain beneficiaries with, either gambling issues, it could be substance abuse, it could be just a spendthrift, someone that's not responsible with money. Gosh, if now these IRAs are in the millions and you're going to give someone this type of money, right? What type of guardrails can you put guardrails on it?
Because you don't want somebody to be reckless with your hard-earned money, and you don't want to really put them in a position to hurt themselves.
And keep in mind, sometimes if you're a spendthrift, you're not taking into account that every dollar you're spending, there's a tax that's due. Right. So suddenly now, a year later, you find yourself with this huge tax bill, and perhaps the asset is not there to pay the bill.
Yeah, and going a step further, I know you've mentioned special needs children too, right? There's issues
Correct.
there with that you know, them getting a certain amount of income, maybe it affects the money they're getting from the government, or
Correct.
Things like that.
Correct. You nailed it, because $2,000 worth of assets will many times stop their government benefits. So if they're receiving Medicaid, supplemental Social Security, if they're receiving any of those, if they inherited $2,000 or more from your IRA, in other words, they were one of the beneficiaries of that IRA or that 401k, right? Basically, their government benefits stop. Now, you can reapply for it, right?
Sure.
And after a few months, you can get it back again. But now what you're dealing with, and what the courts will likely do, is say that it has to be placed in a trust so that the child has this money managed for them and they're taken care of. But this is where you hear about those clawbacks. When the child passes away, then the government claws back assets. If you're able to set it up in one of those trusts from the trilogy, what we call our DTC. DTC stands for Dunham Trust Company, but DTC, Special Situations Trust. If you place it in there, then it's what's called a third-party trust. More information than your listeners need. But what it means is that when the child, so it means that, number one, the government benefits are not disrupted. And it also means that when the child passes away, those assets can go to their brothers, sisters, or anyone else that you would want to leave the assets to. There's no clawback on those assets.
Third part of the trilogy would be what?
So the first part is the elimination of the Secure Act. Second part is guardrails. And then the third part is there may be people that will say, okay, if my kid has to pay taxes, that let him pay taxes. I don't want to do, because the way you avoid the Secure Act tax is utilizing a charitable remainder trust, right, as the beneficiary of the IRA.
Gotcha.
So here's the beauty of this, and this is the reason that I love this. So the charitable remainder trust, all you're doing is naming that trust, and again, just because we just jumped from one concept to another, we're talking about the elimination of that Secure Act tax so that your children have more income, because if they're not giving away half of their assets to taxation, they have to have more income, right? Mathematically, they have to have more that they can enjoy, right? But the way you do that is because you're naming the CRT, the charitable remainder trust, as the beneficiary of your IRA,
okay,
and then your child as the income beneficiary.
Gotcha.
So they receive then that lifetime income, and your estate receives a tax deduction, which today you can leave $20 million, $60,000, without paying tax. But that sunsets, right? And it sunsets down to $6 million per person in 2026, right? So that tax deduction may come in handy. But in my situation, I cannot use the charitable remainder trust. So please, I would encourage your listeners to hear the discussion on the charitable remainder trust, understand the issue here. But if you're young, the charitable remainder trust doesn't work, right? So typically, based on the situation today, you'd need to be about 28 years old in order to make it work. So for me, it wouldn't work for my girls because they're too young for that, right? But let's assume for a moment that they were old enough and we set up the CRT. That means my girls will be receiving much more income than they would if they pay the tax. But here's the drawback. My grandchildren, if I had grandchildren, right, my grandchildren don't get any of those assets because the remainder, whatever remains in that trust,
goes to the charity.
Exactly. So the way you mitigate that is now the third trust, what we call a replacement trust. So what you do is you utilize life insurance, and you have the life insurance replace the assets, some or all of the assets that would have gone to that would go to the charity. Right, and here, what you would do is you'd place it on my daughter's life, where the premium would be much, much less. Right. So if you think about it, I have
for her child.
Correct.
Yes.
Correct. So I have my IRA. Right. During my lifetime, what I do is I would name and assuming obviously it would go to my wife first. Right, and then after if I died first, then my wife would have it, and then when she passes away, it would go to my girls, right? But when it reaches the point that it goes to the non-spousal beneficiary, right, and that's where then that Secure Act tax occurs. When that occurs, then what you do is you name the CRT as the beneficiary. So I pass away. The money now goes into the trust because it's a tax-exempt entity. There's no Secure Act because my girls are the income beneficiaries. They receive income for the rest of their lives. But now what you do is you use the replacement trust. You place life insurance on my girl's life, right? So then when she passes away, but now the life insurance pays. My grandchildren, they remember Pop-Pop because Pop-Pop left them the life insurance policy. If the replacement trust is properly situated, they will receive those proceeds free of estate tax, free of income tax, free of capital gains tax. It is the most tax efficient asset you can leave to someone you love.
That's awesome. I mean, at the end of the day, the IRS or the IRA Trust Trilogy, like you said, does multiple things. The first thing, like you said, is instead of them having to take it over that 10 years with the Secure Act, having something like this eliminates that and makes it more of a lifetime strategy, correct?
And much more money. So we have run a number of scenarios. And what we try to do is replicate what my girls would, if I were leaving this for my girls, what they would receive utilizing the charitable remainder trust versus paying the tax. And you run out of money. But just common sense. If I'm paying this large tax, then of course I can't replicate something that didn't have to pay the tax.
Yeah.
So my girls would wind up with much more income utilizing the CRT, and then just use the replacement trust, have the life insurance, and my grandchildren could receive something as well.
If you're listening there and you're like, wow, I have a huge IRA, and instead of leaving the IRS as a beneficiary to a third, a fourth, 50%, whatever state you live in, depending on the tax, you may ask yourself, is there something that I should be looking at that is another viable option, like the IRA Trust Trilogy? And what is it going to do for me? How is it going to put me in a better position? And like Sal says, if we compare it to what would happen if you did nothing versus this, I think that would be a great way for you to analyze to see if it's in your best interest.
I would suggest to your listeners they owe it to themselves to at least listen to what this is about, and just to discuss the things that they may be concerned about, right? Because this asset is, to me, I view it as a sacred asset, because this is what I've worked my entire life for. This is what I've saved for my entire life, and I wanted to benefit the ones that I love.
Couldn't say it better myself. Thank you, Sal. We appreciate you being on the show and finishing up this series. If you are interested in learning more about the IRA Trust Trilogy, the CRT, the Donor Advised Fund, anything that me and Sal talked about during this series, give us a call, go on our website, or shoot us an email and let us know, and one of our advisors will be able to sit down with you to tackle the problems that you're going to have or you may have, and how these might be the solution for you. Thanks for joining us this day and for the series that we've been able to tackle with Sal. And we look forward to talking to you soon.
Registered representatives offer securities through Independent Financial Group LLC, IFG, member FINRA SIPC. Investment advisor representatives offer advisory services through Independent Financial Group LLC, IFG, a registered investment advisor. Cornerstone Wealth Management, IFG, and Dunham & Associates Investment Counsel are unaffiliated entities. The information and opinions presented are for general information only and are not intended to provide specific advice or recommendations for any individual. You should contact your investment representative, attorney, accountant, or tax advisor with regard to your individual situation. The opinions of the presenter do not necessarily reflect those of Independent Financial Group LLC, its affiliates, officers, or directors.